Remember that we have to understand how firms make decisions so we can influence them. Let's work on that a bit. The symbol for profits is pi. Profits equals total revenue minus total cost. Total revenue is easier to understand. It's just price times quantity. Think about it. If you produce 40 chairs and each chair costs $10, when you sell those chairs, your revenue will be $400. You just multiply price and quantity. Costs, on the other hand, they are a bit more complicated. Total costs include both explicit and implicit costs. As a result, the costs considered by economists are not the same as the costs considered by accountants. Now, accountants only consider explicit costs. What are explicit costs? There is a cash payment, including cost of material, cost of hiring workers, etc. Now, when you go and hire somebody, you actually have to write a check for this person. So there is a cash payment. Now, when you buy some material, it's the same thing. There is a cash payment. Economists, on the other hand, in addition to considering explicit costs, they also consider implicit costs where there is no cash payment. What is the typical implicit cost? Is the opportunity cost, the owner's time, and the return that could be earned on the capital if it were invested elsewhere. A good example is the following. When you go to school, there are many explicit costs. There are the tuition fees, the price of the books. All of these you actually have to write a check. Now, on the other hand, if you are going to school full-time, you are foregoing wages. Basically, because you are going to school full-time, you're not working. That money you would be making if you were not at school, that's your implicit costs. Considering the implicit costs or the opportunity cost of college. For me, my opportunity cost of college was very low, because if I were not in college when I was young, I would be, bartending. And therefore, I wouldn't be earning that much money. But consider an athlete, for instance. If an athlete stop being an athlete and go to school full-time, all that money that athlete would be making is an opportunity cost. Now, if he's a super athlete, that's a lot of money. Those are millions of dollars. So the cost for those athletes to go to college is much higher. As a result, economic profits are different from accounting profits. Accounting profits are the following: total revenue minus explicit costs. Economic profits, on the other hand, include implicit costs, so total revenue minus explicit costs minus implicit costs. Here's an example. Let's say that after you're done with school, you open up your own business. Your revenue is $100,000. The cost of material is $25,000. The cost of hiring workers is $25,000. And other out-of-pocket costs, $10,000. Those are all explicit costs. So according to your accountant, your accounting profit is $40,000. On the other hand, there are the opportunity costs. For instance, let's say that instead of opening up your business, you were offered a job, and the money you would be making in that job is $50,000. That is your opportunity cost, because if you had not opened your business, that is the money you would be making. You are letting go, that's the money you're letting go to work on your own business. that has to be included in the calculation of profits. So when you subtract the opportunity cost as well, not only the explicit costs, you can see that your economic profits is minus $10,000. So explicit costs, 100,000 minus 25 minus 25 minus 10, 40,000. That's your accounting profit. But your economic profit is actually an economic loss, because when you subtract the opportunity cost as well, the profit is minus $10,000. Well, and it makes sense that you have to take that into account. Think about it. Either you make 50,000 on a job, or you make 40,000 on your own business accounting profit. You can see that your opportunity cost is huge compared to the accounting profit. You, instead of, unless you have other considerations, if you're thinking strictly about profit, it is profitable to go to work and make 50,000 instead of opening up your own business and make 40,000. So you can see that the relevant cost is actually the economic cost. The relevant profit is actually the economic profit, because it takes into account how much money you would be making in your best alternative. In a competitive equilibrium, in the long run, economic profits are zero. However, that doesn't mean that accounting profits are zero. If they were, nobody would be working. So when we say that in perfect competition profits are zero, we do not mean that nobody is making any money. What we mean is people are making money as they would in their next best alternative. So it makes sense. It's not a bizarre scenario when we say that profits are zero, as long as we say that economic profits are zero, not accounting profits. Now, business decisions are based on profits. And from now on, whenever I say profits, I mean economic profits. In your book, it says the following. Suppose a firm is considering a decision to add to its output. Profits would increase only if the addition to total revenue, called marginal revenue, are greater to the addition to total cost, called marginal cost. So, let's say instead of 5 units, you consider producing 6 units. Your revenue is going to increase because you are producing and selling 1 more unit. But your cost is also going to increase because it takes inputs and work to produce that extra unit. So, to produce 1 more unit, revenue increases, that's marginal revenue, and to produce 1 more unit, cost increases, that's marginal cost. If marginal revenue is greater than marginal cost, meaning if that by producing that extra unit you increase revenue by more than you increase cost, then you should produce that unit. Conversely, if marginal revenues are less than marginal costs, firms will not undertake the action under consideration. Before you explore that, notice that it is true for any action, not only increase production. For instance, instead of increasing production, you may be thinking about improving product quality, increasing advertisement, etc. Any action. If whatever action increases sales and rents total revenue, but if these steps increase costs more than increase revenues, profits will decline. Marginal revenue has to be larger than marginal cost. Now let's explore this a bit. I am assuming here perfect competition. In perfect competition, firms are price takers, meaning you're such a drop in the ocean, there are so many other firms, competition is so fierce, that it doesn't matter how many units you produce. Prices are always the same. You can produce 0, or you can produce as much as you can. You are a drop of water in the ocean. You do not affect the equilibrium price. That is what perfect competition means. So let's say that if you produce 0, 1, 2, 3, 4, 5 units, the price is always the same, 10, 10, 10, 10, 10. How do you calculate total revenue? Is quantity times price. If you produce nothing, your revenue is 0. If you produce and sell 1 unit, revenue is 10. If you produce and sell 2 units, revenue is 20, etc. With that information, you can calculate average revenue, which is total revenue divided by quantity, basically the average you make per unit. Now, there's no division by 0 in mathematics, so we don't have average revenue when quantity equals 0. But when quantity equals 1, price times quantity is 10, then you divide by 1 is 10. Average revenue is constant, and the reason is prices are constant. But that's not what really matters here. What matters here is the marginal revenue. As you see, the marginal revenue will also be constant because of perfect competition. Marginal revenue is the change in revenue when you increase the unit. So, as I increase quantity from 0 to 1, my revenue increases from 0 to 10, so my marginal revenue is 10. If I increase quantity from 1 to 2, my revenue increases from 10 to 20. From 10 to 20, the difference is 10, so my marginal revenue is 10. As I said in the previous video, some books consider marginal revenue the revenue of the next unit. Some books consider the marginal revenue the revenue of the last produced unit. In this book, the book where I took this exercise from, they consider something in between here. So the marginal revenue is defined as I increase from 0 to 1. That's why it's in the middle here, between these two. There's no right way to define this. It can be either way. Anyway, as I increase my quantity from 3 to 4, my revenue increases from 30 to 40. So the difference between 30 and 40 is 10, so my revenue increased by 10. Notice that marginal revenue equals price. That is always going to be the case if you have perfect competition. That is never going to be the case if you don't have perfect competition. But let's stay with perfect competition now. We're going to see other market structures later. Okay, now let's say this is our total cost. And these numbers are kind of invented. Okay, so assume that I produce 0, my total cost is 5. This is called the fixed cost. It is the cost that I incur regardless if I produce anything or not. An example of fixed cost is rent. It doesn't matter if you don't go to work any day of the week in your business, you're still going to have to pay the rent. So the rent is a fixed cost. How do you figure out the fixed cost? Look at your cost when quantity is 0. That's the fixed cost, the cost you have to pay even if you don't produce anything. Then, if your quantity is 1, total revenue, we got it from the previous slides. Total revenue is 10. That's this column here that it's copied here. And we are assuming that the total cost is 9. If you produce 2 units, we saw that total revenue is 20, and we are assuming that total cost is 15, and so on. We already calculated marginal revenue in the previous slide. Now let's calculate marginal cost. As I increase quantity from 0 to 1, my costs increase from 5 to 9. The difference is 4, so my cost is increasing by 4 units. As I increase quantity from 1 to 2, my costs are increasing from 9 to 15. So the marginal cost is 6. That's the difference in cost as I produce one more unit. If I increase quantity from 2 to 3, total cost increases from 15 to 23. The difference is 8, so that's my marginal cost. Now, let's compare this with profit. How do I calculate profit? It's total revenue minus total cost. So minus 5, 10 minus 9, 1, 20 minus 15, 5, 30 minus 23, 7, and so on. You can see the maximum profit is here as I increase from 3 to 4 units. Okay, so my maximum profit would be around 3 and 4 units. This is the case when marginal revenue equals marginal cost. And in fact, that is the profit maximization rule. How do you know you're maximizing profits? When marginal revenue equals marginal cost. That is true for any market structure, although in different market structures, marginal revenue is not necessarily equal to price. But this rule is also true. It doesn't matter if marginal revenue is equal to price or not. When marginal revenue equals marginal cost, that's the quantity that you are maximizing profits. At any Q with marginal revenue larger than marginal cost, increasing Q raises profit. 10, 4, if I increase Q, increase profits from minus 5 to 1. At any Q with marginal revenue smaller than marginal cost, reducing Q raises profit. So instead of 5, when my profit is 5, if I produce 4, my profit will be 7. Again, how do firms maximize profits? They pick quantity. So here are many options of quantity. They pick which quantity to produce. The quantity that marginal revenue equals marginal cost.